Hello. Welcome back, friends, to Alpha Beta Soup. I'm TXMC. Today, we'll bounce around a little bit. I want to talk about a couple of the recent earnings reports of the last couple days and how they're affecting the market, how it relates to consumer strength and economic health. We'll also touch a bit on Bitcoin value zones and on-chain, and then we'll talk about recession risks and how it ties into past history around high CPI prints. All of that is coming up in this episode, so don't go anywhere. If you enjoy my content, make sure to give this video a thumbs up and subscribe to the channel. We're growing quickly, and the support of each and every one of you means the world to me, so thank you very much. Now, we have much to discuss, so let's dig in. Well, as we sit here on this Tuesday morning, Bitcoin is around 20,800, and it's been declining after breaking down below the 200-week moving average yet again. And when you look back through the history of Bitcoin, this is actually the longest battle that it has had with the 200-week in its history. Now, encounters with this indicator are very limited. There's only been 2 or 3 instances in the past where Bitcoin had a relationship with the 200-week, so the sample size is very small. But the previous instances didn't have this long of a battle, and I think we may still have further to go here. You know, there was a lot of excitement a few days ago as we got over the 200-week moving average, and it looked like maybe we were climbing out of this little channel we had tried to establish. But here we are, alas, breaking down below it again. It's hard to know exactly where the bottom is. If I look at candle closes, maybe there's a little bit of support down here in the middle 19,000s. Hard to really say, and I'm not trading this action, so trying to identify entry points is just not something of interest to me here, particularly when I consider that the economic story that we find ourselves in is nowhere near its conclusion. There's still far more to play out, so whatever Bitcoin is going to do here really relies on what that story looks like for the economy. You know, I get pretty frequent requests to talk more about on-chain data to show what's going on the Bitcoin ledger, and the reason I'm hesitant to spend a lot of time on that is because there is simply no signal in that data right now, and I don't know how to emphasize that more clearly to you guys. We will not get an edge about what's happening to the market right now by looking at Bitcoin on-chain. It simply will not provide it. Now, I do keep an eye on it. I like to go check and make sure there haven't been any anomalous prints on various metrics, but the majority of on-chain is signaling that we are in a value zone, that Bitcoin is significantly drawn down from its previous highs, but all that is very obvious if you've been paying attention to the market. And when you want to identify value zones using on-chain, look no further than the realized price, seen here in gold. We did take a trip down below it, and these visits through the history of Bitcoin are exceedingly rare. The realized price is the cost basis of all coins when they last moved on the ledger, and when price goes below that value, the majority of Bitcoin supply is in loss. It's sitting with a native price higher than the current traded price. And when we take dips down below the realized price, for people like myself that have a long-term investment thesis for Bitcoin, those are opportunities to pick up corn at a value. That's not advice for you. You need to make your own decisions, but that's my strategy. And I think that since we've got a few more shoes to drop economically, we may see another visit below this value. But you know, if I'm trying to challenge my bearishness, because you guys know I am pretty bearish on the economy broadly, but if I'm trying to challenge my bearishness, you know, it is pretty clean and nice how Bitcoin was able to catch itself on its 786 retracement here at the lows in June. It caught it very cleanly, and when you think about what comes below this level, there's really not a lot of support below here in terms of Fibonacci levels. So if we're going to put a feather in the cap of something bullish after talking for many months about predominantly bearish things, one could say that this is relatively bullish, that we were able to put in a wick here around 18,000 so cleanly on the 786 retracement. And in fact, this level is not that far from the 2017 all-time high. There is a little bit of support here in the idea that perhaps the low for Bitcoin is in, but I'm not ready to make that call right now when I look at the broader economy. And we can see when we look at Bitcoin compared to the S&P, the Dow, the NASDAQ, everything is kind of bowing over a little bit here. Some of this is related to some less than impressive earnings that have come out this week, which we'll touch on here in a moment. But you can see that this movement is not unique to Bitcoin. The S&P curling, the NASDAQ curling, the Dow is red, but it moves a little more slowly. The markets are softening a bit after a pretty strong rally off of relative lows. And a lot of this weakness comes from what happened to Walmart and what that may suggest for other retailers. Yesterday and after hours, Walmart got absolutely whacked after their Q2 earnings came out, and they fell 10% in a matter of about an hour, all the way back down here to 2022 lows. And when you go dig into their earnings report, it doesn't look particularly great. They cut their profit outlook for the rest of the year significantly. And after that adjustment, they now think that end of year earnings, so total 2022 earnings, will come in at 11 to 13% negative. That's a decline of double-digit percentages after previously expecting flat to slightly positive earnings for the year. They have adjusted that to double-digit losses. The reasons that they cite for this are inflation, causing shoppers to spend more on necessities like food and less on things like clothing and electronics. Well, friends, this is exactly what we have been talking about for months. On my channel and on Twitter, we have been discussing at length about earnings reports and expectations still being very positive. Many analysts and talking heads in the industry were still expecting double-digit earnings growth for the second half of this year, despite all of the economic uncertainty we're looking at. And as you can see here, I have been tweeting about this and talking about this at length. And a lot of it makes sense when you consider what's going on with the American consumer. So right here, we're looking at food at home costs year over year, and they are up 12.2% from where they were last year. This is the highest yearly advance in food at home costs since 1979. Now, the reason that this matters is because food at home for many people is a non-discretionary expense. For the millions of Americans who live paycheck to paycheck, who do not have an excess of discretionary money, food at home takes up an exorbitant part of their budget, and it's not something that they can make a lot of cuts in, right? You can only choose the cheaper brand of eggs and milk so many times on the shelf before you're already buying the lowest brand. And when you reach that point, you start cutting in other areas. Maybe you stop buying clothing quite as often. Maybe you cut back on subscription services, on digital media. Who knows what it is? But you start making sacrifices because the things you absolutely must have, non-discretionary hierarchy of needs type of things, shelter, food, the ability to get to your job, those things are of paramount importance. And when they're taking up a considerably larger portion of your budget than they were last year, food being 12.5% almost higher than it was last year, that puts significant pressure on consumer budgets. So a place like Walmart that has a lot of people who live on the margins, a lot of people who live paycheck to paycheck, they are experiencing it firsthand. And this is a company, Walmart, who is the largest employer in America. They have over 2 million employees, and they have some of the most advanced real-time consumer data available globally. So for them to have missed their projections this much, for them to have underestimated the inflation problem this much, and to have over-ordered on products and swollen their inventories to this degree, for them to have missed all of this so significantly does not spell much success for the rest of the industry. Because Walmart, as I said, they have some of the best consumer data available, and being such a large and efficient company, they are extremely tight about their spending. They have everything marked down to the penny, and they missed the boat on this significantly. So that does spell considerable uncertainty for the retail industry for the rest of the year. And I think the market is responding to that today. And on top of this, the damage this week hasn't been isolated just to Walmart, even though they made the biggest splash. Shopify announced a 10% layoff of their workers, another darling of the recent bubble, announcing layoffs, and their stock fell 15% this morning. Another company that announced earnings today is UPS, and they're experiencing problems of their own, but with similar echoes to what we're seeing in the retail space. So UPS announced positive profits, 5.9% group revenue up year over year, domestic revenue up 7.4% year over year. But the problem for both of those numbers is that they are below the inflation rate. So while they experienced nominal growth in profits, they are experiencing a real contraction in growth. They say that much of their positive nominal revenue growth was driven by a 12% jump in revenue per piece, which means that they were able to pass on higher costs to consumers on a per item basis. So they were able to create higher nominal revenue simply by raising prices. And if we go look at the Wall Street Journal as they unpack the UPS earnings a little bit more, they talk about that. The company said its effort to pass along higher costs haven't damaged the business. However, average daily shipping volumes fell 4.8% from a year earlier. So they did post positive earnings, but when you adjust it for inflation, it's negative. Their volumes are down, and the main reason they were able to stay profitable is because they raised the per unit cost of shipping. So we've got a fair amount of window dressing going on here, where we're still seeing positive sales numbers, but when you adjust them for units moved and you adjust them for inflation, there is significant weakness under the surface, and the market is starting to sniff this out. I think when you take inventory of all of these signals that are flashing at us that the economy is headed for a recession, and then you come and look at the 2s-10s yield curve. This is the differential between the 2-year and 10-year treasury. It is significantly inverted below where it was in April when it first dipped into this territory. But this particular yield curve is one often dismissed by talking heads who say this is not the more accurate recession signal. They point to the 3-month 10-year yield curve. Well, friends, that one is headed straight down. And at the current pace, it will be inverted within about a week or so if it maintains this rate of change. And what that will mean once this gets down below zero is that yet another highly accurate recession signal will be flashing red in the face of comical denial by policymakers. They continue to rug pull the American public on the idea of a recession being imminent, even though more and more recessionary signals are flashing clear alerts. Once the 10-year 3-month curve inverts, there's almost no way for them to deny that we are heading for a recession because this is arguably the most accurate of all signals. And it usually means that within a calendar year, the economy experiences a bona fide recession. Now, this week, we will get GDP numbers. They come on Thursday after the FOMC. So we've got a huge week of economic events unfolding here. We're already in the middle of a massive Q2 earnings season. Big tech reports this week. We'll get the FOMC result on Wednesday. They'll probably raise 75 basis points. The market is pricing in 75 basis points. They've got a 75% chance of that happening. And then on Thursday, we get the Q2 GDP numbers, where they will most likely be negative, friends. If we look at the Atlanta Fed's GDP Now algorithm, which takes a bunch of inputs to the GDP in real time and tries to project what it thinks GDP will end up at, it's showing well below -1%, another quarter of negative GDP growth. Now, while that is a technical definition of a recession, as we've talked about on my channel, the NBER will go out of its way to claim that 2 quarters of negative GDP growth are not a recession, and they will claim that it's because employment remains strong, that unemployment is stuck at 3.6%, and that, in their minds, suggests we are not in a recession. That will be the narrative they try to pump out, and you can already see this happening to a degree. What do I mean by that? Well, the White House put out a note the other day talking about how recession is not necessarily 2 quarters of negative GDP growth. Literally what we have been talking about, they're trying to spin it into something positive. They're trying to convince the American public that we are not headed for what we absolutely are headed for. And this is just lipstick on a pig at this point. The desperate throes of a weak administration in a midterm election year that has no material solutions to offer the American people. So all they can do is try to manipulate sentiment by pointing out minor changes to gas prices and quibbling over the definition of a technical recession. But there's even more evidence that we may be headed for a recession, and it relates to something Stanley Druckenmiller recently said in an interview. Stan Druckenmiller is one of the most legendary investors of our time. And he recently gave an interview on YouTube, and I listened to it and took a bunch of notes because I try to learn as much as I can from folks like himself. And one of the things he pointed out in his interview was CPI, once it gets over 5% in American history, has only been resolved through two means: by jacking interest rates up higher than inflation to try to slay it, or by having a recession. Those have been the only two ways we've been able to avoid high inflation getting entrenched. So I decided to try to chart this and visualize what Stanley Druckenmiller was describing. And this is what you're seeing on my screen. So let me walk you through this. These black lines represent the CPI, and it's only shown when CPI is over 5%. 5% is this dashed line going across here. So you notice CPI is only appearing above this value. We're not seeing the 2, 3, 4% CPI values. In orange, these bars, they represent the short-term interest rate, the core interest rate in the United States. And what we can look at back through history, we can see these periods of inflationary spikes where we saw greater than 5% CPI. We can see that most of those instances, interest rates were well below inflation. It was only here in the 70s, in the Volcker era, where they tried to attack inflation through interest rates. They jacked the rates up above CPI in an effort to cool off the economy and kill price growth. Now, what I've got at the bottom is some color coding for this criteria we're trying to hunt out. In the blue, in this top row here, this represents periods where the CPI was 5%, and within a year from there, the short-term interest rate was higher than the inflation rate. So when that happens, you see prints of blue, and you notice most of them are consolidated in this late 70s, early 80s era, the Volcker era, where we were just talking about them jacking up rates to fight inflation. These red bars indicate times in history where we had 5% CPI, and we experienced a recession within 1 year of that print. That is much more common, and it follows virtually all of these prints, including the ones in the 70s when we jacked up rates. There was only one instance here around 1977-78 where we jacked interest rates above CPI and we avoided a recession for at least a year. You can see these gray bars down here. These are all of the recessions, regardless of the criteria. So you can see where they line up. There's a few takeaways from this chart. Stanley Druckenmiller is dead right. The US has only been able to avoid 5% inflation becoming entrenched by jacking interest rates up above CPI or by experiencing a full-blown recession. There's only a couple of instances where it wasn't true. To be fair to Mr. Druckenmiller, he wasn't 100% accurate. He was about 90% accurate. There are a couple of instances where we did see high CPI and we did not jack up rates or have a recession. One of them was in 1942 and 43 when we were in the middle of World War II. We were spending in significant deficits to drive the war machine, and we avoided a recession. The same thing happened in the early 1950s at the height of the Korean War, when again we ran heavy deficits, we caused a lot of inflation in the domestic economy, but we avoided a recession. It didn't kick in until middle of 1953. Aside from the Korean War and World War II, all of these other inflationary spikes completely match with Mr. Druckenmiller's assessment. We must combat it through interest rate policy or through recession. Now, I think it's pretty obvious that where CPI is right now, over 8%, 9%, we're not going to combat it with interest rates. We're not going to get core interest rates up to 7%, 8%, 9%. Considering current debt levels, that's almost financially impossible to do. So that means the only real tool remaining based on over 100 years of financial history in this country is a recession. And when you think about how this 10-year 3-month yield curve is heading straight into hell, the 10-year 2-year yield curve is already inverted, and many of the other things we've talked about, weakening corporate earnings, downgraded outlooks, consumers getting squeezed, all of this suggests we are absolutely headed for a recession if we are not already in one right now. You could make make the argument that we are. So when I take all of this into consideration, it seems to me that the economy still has more of this act to play out. There are still more shoes yet to drop. There are still places in the economy where the tightness of the consumer and elevated costs have not fully manifested in weaker outlooks, in weaker profits, in announcements of reductions in staff. That hasn't fully rippled across the economy. But when you see things happening to Walmart, happening to Shopify, when UPS is struggling to remain profitable, there are signs occurring that perhaps this next quarter, this Q3 that we're in now, might be where we really start to see the wheels come off the bus. It's hard to know exactly. We're going to continue to watch the data as it comes in and remain objective. But if I'm trying to project ahead, much of what we've been talking about since March and April and May is starting to come true. And once it begins, it can really become kind of an avalanche, because as the consumer weakens and companies let people go because their profit margins are cut, those people lose jobs. It becomes harder for them to spend. The consumer is further weakened and it causes more deterioration. It's almost a negative feedback loop. So I'm really leery to watch for that trend unfolding. And one of those places you can kind of see a softening occurring is here on initial claims. So these are people filing jobless claims through the unemployment process. And this has been climbing since mid-March, and it's up about 60% off the lows. This is typically a recession signal, even though it's coming from an historically low place. So I know we bounced around a whole lot today. We talked about Walmart earnings being less than impressive. We talked about UPS reporting positive revenue, but lower shipped volumes, and much of that coming because they were able to pass costs along. But there are recession signals flashing all over the economy, and very soon one of the most accurate signals will print, and there will be even less room for the Fed, for the Treasury, and for the White House to make excuses about us not entering a recession. So that's really what I wanted to talk about today, friends. We bounced around quite a bit, talking about corporate earnings, talking about yield curve inversions, talking about Bitcoin and value, and I hope that I was able to make a cohesive argument for what I'm looking at right now. We will let this market play out for a couple of days. We'll pay attention to the FOMC tomorrow, which is must-watch TV. We'll pay attention to the Q2 GDP numbers, at which point the markets may feel that we've gotten confirmation of a technical recession, and it may begin to react in that fashion. We'll have to see. If you have any questions for me, any feedback about my channel, please leave it in the comments below and I'll be happy to read them. And we'll give this market a few more days to play out. We'll probably put out another video near the end of the week. Make sure you're following me right here on Twitter at TXMCTrades. You can ask me questions here, you see my ongoing observations about the market, and I'm pretty active. And that's where we'll leave it today, friends. If you enjoyed this content, please give this video a thumbs up and subscribe. Your support means everything to my ability to continue making content. So until we speak again in a few days, take care of yourselves, friends. Take care of your families, be kind to each other, and we will chat again in the very near future. Cheers, everyone.